Hello all, welcome to the session. In this session, I'm going to talk on the replacement decision, the technique which is used in the financial management. Decision regarding the let's start with the replacement decision. Decision regarding replacement of an existing asset with another is based on the net present value and internal rate of return of the incremental cash flows. So that is the difference between the periodic net cash flows if the existing asset is kept and the periodic net cash flows if the asset is replaced. In capital budgeting and the engineering economics, the existing asset is called the defender and the asset which is proposed to replace the defender is called the challenger. Estimation of incremental cash flows for such replacement analysis involves calculation of net cash flows of the defender, net cash flows of the challenger, and the finding the difference in cash flows for the both assets. Technique: calculating periodic cash flows of existing asset is straight way forward. Since the existing asset is already purchased, the initial investment outlay is zero and the periodic net cash flow are calculated based on the following formula. So here is the formula. Net cash flow is equal to, in bracket, revenue divided by the operating expenses divided by the depreciation into 1 minus tax rate plus depreciation. If the asset is replaced, it involves investment in the new asset and the sale or disposal of the existing asset. Disposal of existing asset has some income tax implications which need to be reflected in the calculation of initial investment as follows. Initial investment after replacement is equal to cost of new asset minus sale proceeds of the old asset plus minus tax on disposal which is occurred on the old asset. Tax on disposed asset. So we have formula to calculate tax on different disposed asset. This is equal to sales proceeds of old assets minus book value of old asset into tax rate. As evident from the equation above, if the old asset is sold to an amount higher than its book value, the company bears a related tax cost which is added to the initial investment. As evident from the equation above, if the old asset is sold at an amount higher than its book value, the company bears a related tax cost which is added to initial investment. Similarly, if the sale proceeds are lower than Similarly, if the sales proceeds are lower than the book value of the asset sold, there is a resulting tax shield which is subtracted from such sum of the cost of new asset and the sale proceeds of the old asset. Example: M1 bus. M1 bus operates bus on different intercity routes. The management is considering upgrading its fleet of 50 standard buses purchased at 8 million, which was a book value of 3 million. It expects to sell the existing fleet for 4 million and purchase a new fleet at the cost of 12 million. The existing revenue of the fleet is the 4 million per annum, which is expected to rise by 25% per annum. If the new fleet is introduced, the existing operating cost of the fleet, that is 2 million, which is expected to drop by 30% after upgradation. So determine the replacement. If replacement is good idea, if the company's weighted average cost of capital is 10% and the analysis period is 8 years. The company pays taxes at the rate of the 33% at it changes depreciation on straight line basis. Solution: in analyzing whether to replace the fleet or not, we need to work out the net cash flows of the existing fleet and net cash flows after the replacement, and then finding the difference between both to arrive at the incremental cash flows. The incremental cash flows are then used to calculate net present value or net internal rate of return. So existing sheet we have a calculation. Capital investment is 0, revenue is 4 billion, operating cost is the 2 million, annual depreciation is the 8 million divided by 8 is equal to 1 million. Periodic net cash flow, we have a formula to calculate periodic net cash flow, that is the revenue minus operating cost minus depreciation into 1 minus tax rate plus depreciation. So 4 million is the revenue, 2 million is the revenue cost, and 1 million is the depreciation. So 4 minus 2 minus 1 into 1 minus 33%, that is the tax rate, plus 1 million depreciation. So the answer is the 1.67 million. So periodic net cash flow is the 1.67 million. So replace fleet. So cost of new fleet is the 12. For the buying the new bus, the company is needed the 12 million funds. Sell proceed to old fleet. So old fleet is they are selling for the 4 million. Book value of the old fleet is the 3 million. Tax on sale on the 4 million is the 4 million minus 3 into 33, that is the 0.33 million. Net initial investment is the 12 million minus 4 million plus 23 million is the 8.33 million. Net revenue is 4 million to 1.25, it is the 5 million. Net operating cost is the 2 million into 1 minus 10% plus is equal to 1.8 million. So depreciation expenses on new fleet is the 12 minus 12 divided by 8, that is the 1.5 million. So periodic net cash flow, that means 5 minus 1.8 minus 1.5 into 1.1 minus 33 plus 1.5 million, that is a 2.64 million. So now periodic net cash flow is the 2.64 million after replacing the fleet. So incremental cash flow at the 0 is equal to net investment after replacement minus net investment before investment. Incremental cash flows at time 0 is equal to 8.3 million minus 0 plus is equal to 8.3 million. Incremental cash flow in year 1 to 8, net annual cash flows after replacement minus net annual cash flow before replacement. Incremental cash flow in year is 1 to 8, that is the 2.64 million minus 1.6 million is equal to 1.097 million. So 2.64 million was the periodic net cash flow after upgrading the fleet, that is the replaced fleet, and the 1.6 million fleet was the existing fleet periodic net cash flow. So that has been debited by the from the 2.61 million. So answer is the 0.97 million. So calculating net profit value, that is the PV factor for 8 years at 10% incremental cash flow, year 1 to 8 increment minus incremental initial investment. So NPV is the 5.335 into 0.97 million minus 8.33 million. So NPV is the 3.15 million. So IRR, interest rate return, is the 2%. Since the net profit value is negative and IRR is way below the hurdle rate, it is not feasible to replace the fleet at this stage. Okay, so this is how this replacement decision method I have explained with the incremental cash flow and the replaced fleet and the existing fleet. So here we are done with the replacement decision technique. Okay, see if you have any doubt you can contact me personally, so we will talk in details. So I will explain you the replacement decision method. Okay, so thank you, best wishes.